Would you say no to a 5.8% increase each year on your state pension for the rest of your life? Well, that is exactly what you get if you defer your state pension by 1 year. And in this video, I'm going to tell you exactly why I don't advise my clients to defer their state pension and the key rules which surround deferring your state pension, which you need to know before you make this decision. I'll also tell you before the end of this video the 3 key reasons why this is the case, an alternative strategy which could give you over £55,000 extra, and the one circumstance which I think deferring might make sense. But for me, there's only kind of one reason. Okay, so let's go over the rules because it's important that you understand this to help frame the decision. Firstly and crucially, I'm going to be talking about here if you defer your state pension under the new state pension rules, which came into force on the 6th of April 2016. I will mention some rules later if you're on the earlier system, so if your state pension started before the 5th of April 2016, but the reasons I give not to defer are based on the assumption that your state pension date is after, so bear that in mind. Now, you can choose to defer your state pension for as long as you want after reaching state pension age. For each year you defer, your state pension increases by 5.8%. And this is approximately 1% increase for every 9 weeks of deferral. So you can no longer receive a lump sum payment under the new system if you defer your state pension. The only exception to this is that you can backdate your claim by up to 12 months and take a lump sum for that period. Now, when you do that, no interest is added to this lump sum. So it's a relatively short period where you can potentially get a backdated lump sum in exchange. And just in case you don't know, state pension payments are subject to income tax. It's just that tax is never typically deducted from it. Instead, the amount is paid is added onto any other income, and if the total is more than your individual's personal allowance, what's currently $12,570 and comes through tax-free, then tax is normally deducted from the other income. So for example, let's say you're receiving another pension income or some employment income, HMRC will adjust an individual's tax code so that the tax paid includes the amount due on your state pension. And the pension income is taxed normally through PAYE, pay as you earn. So if you're watching this and you're perhaps someone who's planning to continue working, and when your state pension comes into payment, you might be put into the higher rate tax, so at 40%. You might be thinking, well, hold on, hang on a second, I'm going to pay a ton of tax. Well, if that's the case, look, I've got an answer for you, just hold on. The first reason I typically don't advise deferring the state pension is the deal. Look, if you defer your state pension, it takes on average about 17 years to get to a break-even point, where the amount you've given up gets recouped. So, assuming you hit state pension age at 67, honestly, who wants more income at age 84? How much enjoyment are you going to get out of the money at that age? Would it not be better to take the money when you've got a chance to enjoy it? As you get older, let's face it, health probably isn't going to improve. Now, the reason why this deferment amount is set up in the way it is it's intended to make it equal. So for a man who's age 67, according to ONS stats, the average life expectancy is 85, with a 1 in 4 chance they'll reach 92. Now, for a female of the same age, the average life expectancy is 87, with a 1 in 4 chance they'll reach 94. But look, the fact of the matter is that none of us know how long we're going to live, or more importantly, how many years we'll have where we can actually enjoy the money. And in my view, I just think it's better to have the money now than to defer it into much later retirement. If that crossover point was age 75 or so, then maybe there's a case. But I just don't think there's that much of a case when you're almost at your average life expectancy when you recoup it. Do you agree? All right, number 2 and the reasons is what happens if you die. So in the new state pension system, basically we've gone over, is it better for you on an individual basis? But what happens for your family, maybe your spouse? If you've reached state pension age on or after the 6th of April 2016, if you defer and then you die before making the claim, the most that falls into your estate is basically a backdated 3 months payment. That's 3 months. So you could have potentially deferred it for 3 years, not drawn the £31,800 or so of your entitlement, but only received 3 months backdated payment, which works out at about £2,500. So under the new system, even if you have a spouse, there isn't a general entitlement to inherit the pension payments that were never paid. The only option that's likely is that if you were married to your spouse or civil partner before the 6th of April 2016, you may be able to inherit up to half of your partner's additional state pension or protected payment. Now, protected payments usually account for any additional state pension built up. And in this video, 10 state pension secrets, I go over this on what it is. So if you're wondering what that is, give that a watch and you can find out. But simply put, look, there's a chance, depending on your individual circumstances, that if you defer the state pension, you die, what your family would receive would be next to nothing, which for me seems a particularly bad deal, especially when it comes to this alternative that I'm going to mention later. So what I said might go against your understanding, and to explain the background to this, there were some changes in the system in April 2016. Before this date, people had two options with regards to deferring the state pension on the older system. One was to simply take their pension later and draw it permanently at a higher rate. The other was to build up a taxable lump sum equal to all the missed pension payments plus interest. And under these rules, the older rules, if someone had decided to defer taking a pension and opted to build up a lump sum, then their heirs and successors could receive that lump sum. There's further details on this in the link in the description if you want to have a look at it. Reason 3, it doesn't improve your ability to receive benefits. Now look, if you're relying on benefits or just a state pension retirement, you're not in a great position financially, but I wanted to mention that you can't use deferral as a way of getting benefits on the ground of low income. If you defer your state pension and try to claim pension credit, you would be treated as if you had claimed your pension in any case. So while you can defer your state pension if you're on benefit, there doesn't seem to be a huge amount of benefit in doing that. So if you're deferring your state pension, you won't build up any lump sum or extra pension for the days that you're receiving the following benefits, and I'm going to list them now just because there's quite a few of them. Yeah, the sad fact of the matter is if the state pension is your only source of income, then there aren't that many financial options available to you in retirement, but I would strongly recommend that if you don't know what pension credit is, please follow the link in the description to find out. Okay, so I've given the reasons why I don't think it makes a lot of sense, but I can hear some of you watching this and maybe you might be thinking, hold on George, look, I'm still working, I plan on doing so for a while past my state pension age. If I take my state pension, this pushes my other income into the higher rate, and then it's going to be taxed at 40%. So I only get 60% of the benefit of the state pension. Well, I have an alternative for you. So you can make pension contributions up till the age of 75. And what you can put into a pension is either the minimum of £3,600 per year if you have no relevant earnings, or 100% of your relevant earnings. So I've done a full video which I explain what relevant earnings are, so give that a watch if you want to look into this strategy. But relevant earnings are effectively employment income, pay, wages, bonus, overtime. But crucially, relevant earnings are not rental income or other pensions in payment. So let's say as an example, you're earning exactly £50,270, which is conveniently just at the very edge of the basic rate band. Now, if your state pension comes in and you have another £10,600 per year, that means that will be taxable at 40%. So you would get £4,240 more in tax compared to what you had before because you've gone to the higher rate. Well, if that money is spare and you are still working, you could choose to make a pension contribution of your state pension amount. And this example, assuming it's a relief at source scheme, that means that you'd make a pension contribution of £8,480. You'd get a 20% tax relief taking you up to £10,600. You could then claim back the other 20% or £2,120 via your self-assessment. So basically what happens here is that across those two options, the 40% tax saved completely offsets the tax due on the pension. But it's more than that. Now you have £10,600 within the pension. And let's say that money was invested at a 5% rate of return after charges. If we assumed that you worked for 5 years and did that each year up till 72, you'd be expected to have about £75,000 in the pot. Clearly that's not guaranteed. And not only can that be spent as you choose in the order that you choose, and then yes, it would be taxable under normal pension rules, but crucially, if you die, you can leave that pot to your family. Not only your spouse, but also to your kids if that's your choice. So what I'm just trying to say is there's some flexibility here for both you and the family. And in my view, that seems a better result than kind of a gamble on how long you're going to live. What do you think? And even if you're one of those fortunate people who maybe has defined benefit pensions which put you into the higher rate, so you don't have the relevant earnings to make that full contribution, you can still put in £3,600 into a pension after tax relief. So I would still say, on balance, I think it's a better option than hoping you're going to live beyond 84. And frankly, look, if you've got guaranteed income sources at that rate, you're doing okay. So this is kind of hypothetical. But, do you remember when I said there was one situation where I think deferring might make sense? Well, before I do that, please do consider subscribing to the channel. It really helps to get the content out to good people like you, and I hope you found this useful enough to stick around. So where I think deferring might make sense is that, look, if you've got very limited other pension income and you're deciding to continue working past your state pension age and you want higher security in later life, then I think it might make sense. So the strategy I mentioned provides extra flexible income, but it's not guaranteed. And maybe based on your circumstances, let's say that you need £11,500 a year adjusted for inflation to make ends meet. And right now you've got £10,600 in your state pension, and that's it. Well, the reality is, in that example, if you were happy to continue working 2 years, then you'd have guaranteed income sources once you took the pension after you deferred it above your making ends meet amount. And having that security, even if you make it up to 95, might make sense for you. So why don't you let me know in the comments, do you think after what I've said, deferring the new state pension makes sense? What are you going to do? Or better yet, I've just done a video which tells you exactly what you need to do to retire well, based on the best data out there and what to expect in retirement. If I'm being honest, it gave me quite a few things to think about my own expenditure and saving strategy. So if you are thinking about that and retirement, I think you'll find it a valuable watch. Either way, I really appreciate you watching. Thanks for your time.